Hello and welcome back to another accounting video dealing with a special topic in inventory. Now we're going to look at retail inventory methods where we estimate the cost of ending inventory using one of three methods: the conventional method, the cost method, and the LIFO method. We'll apply all three to the same problem and see how the answers are going to be slightly different in each case, that is the ending inventory number. Once again, we can use the retail inventory method when there's an observable pattern between the cost and retail prices. There's a conventional method, cost method, and LIFO method. So what's different between the methods? Between the conventional method and the cost method, it's a treatment of the markdown and markups, as in whether we include or exclude it from the cost to retail calculation. For the conventional method, we include only markups in the cost to retail calculation. In the cost method, we include markup and markdowns in the cost to retail calculation. In the LIFO method, we will look at the layers. The layers are beginning inventory, we calculate a cost to retail ratio, and then from the current year's purchases, we will calculate another cost to retail ratio. So let's see how it works in this particular exercise. Here we are told the company began operations on Jan 1st, 2019. They adopted the conventional retail method. None of the company's merchandise was marked down during 2019. And because there's no beginning inventory, its ending inventory for 2019, the 38,100 would be the same whether we use the conventional method or the LIFO retail method. For December 31st, 2020, on this date that store management considers adopting the LIFO retail method and desires to know how the December 31st, 2020 inventory would appear under both systems. All pertinent data regarding purchases, sales, markups, markdowns are shown below. They're also telling you there is no change in the price level. I'll talk about that at the very end. So we'll start out with the conventional method. We'll also look at the cost method, although that's not asked for, and then we'll look at the retail method. So once again, as I mentioned, when you calculate the cost to retail ratio, in the conventional method, we include markups but not markdowns. In the cost method, we include markup and markdown. So let's see how our numbers are going to be different. So for each of these, we have the cost in retail in the first. That's our header that we have for all three methods. I'm going to go ahead and highlight those and show you what they are. Our starting point always is our beginning inventory. So let me go ahead and show you the beginning inventory. It's going to be the same all the way through. At cost, it's 38,100. That number was given to me over here. What was ending inventory at December 31st, 2019 is beginning inventory for 2020. The cost was 38,100. At retail, it's 60,000. So it stays the same all the way through. The next line that's going to stay the same all the way through is our purchases. The purchases are going to be the same in all the methods. The 130,900 at cost and 178 at retail. That stays the same. So at this point, we include the markups only in the conventional retail method. The markups are included over here to come up with the subtotal. And the subtotals are going to be 38,100 plus 30,900 gives me 169,000. And when I add up these three numbers, I get 260,000. Okay. So I'm going to go down over here now. I'll use these two numbers to calculate the cost to retail ratio. So when I do this calculation, my cost to retail ratio is 65%. 169 divided by 260 gives me 65%. I then subtract my sales. I'm sorry, before I get to the sales, I'll list my markdowns. That's over here in this column. And then I'll have my sales revenue, which is going to be, these numbers were again given to me in the problem, the sales number and the markdown numbers. That gives me my ending inventory at retail is 80,000. How do I calculate ending inventory at cost? Ending inventory at retail multiplied by the cost to retail ratio will give me my ending inventory at cost. So my ending inventory at cost is going to be $52,000. Let me move this a little so we can see this. So $80,000 times 65% will give me my final answer that I'm looking for. And I'm going to put that in a different color so we see that number. $52,000 is our final answer. Again, I'll show you the calculation over here. 80,000 times 65% gives me 52,000. That's my estimation. Now, what would be different in the cost method? In the retail, the conventional method, I did not include markdowns in this calculation. So now what I'm going to do over here is I'll have markups and markdowns listed over here. So the markup and markdowns are listed here, and then I have my subtotal. So I have my subtotal. So what you will see is this number becomes different. Remember, markdowns are subtracted. So this drops to 247. So now when I go to this calculation over here, what do you see? My cost to retail ratio has dropped over here. So I'm going to put this in a different color so we can see these numbers. My cost to retail ratio is 68.42%. I put my ending inventory, my sales, and then I get my ending inventory at retail. That number is going to stay the same in both cases, that 80,000. That's not going to change. What's going to change is my ending inventory at cost. Okay, remember this is a computed number. I'm calculating this number based on this assumption of 68.42%. I multiplied by that same 80,000 to arrive at 54,737. Okay, so I'm going to put this in red as I've done before so we can look at that number. And again, I will show you that calculation. It's the $80,000 multiplied by 68.42 will give me 54,737. That's my number over here. So what's the difference between the conventional method and the cost method? It's a matter of where I place the markdowns. Do I include it in the number that I use for my cost to retail calculation, or do I not include it? In the conventional method, I do not include markdowns. In the cost method, I use the markdowns. I include that number to calculate it. This method approximates the LCM, the lower of cost to market, and this one is also called the average cost method. So these are two methods that are available. In our exercise, the company was using the conventional method, which means your answer would have been 54,000. They now want to move to the LIFO retail method. So now let's switch over here and see what we're doing different in the LIFO retail method. What's different over here as compared to the conventional method or even the cost method? As I said, we're going to have layers. The first layer is beginning inventory. There's only one previous layer because last year was our first year of operations. If you recall, they said we began operations in 2019. We're now in 2020. So there are only two layers. So the first layer is that 38,100, which is at 6. In the current year, we have purchases, and then we're going to have our, go back to black color, markups and markdowns. So now this is similar to cost. I'm putting markups and markdowns in this number over here to come up with this number over here. So I have two cost to retail ratios I'm going to calculate. The first one is for beginning inventory. Again, trying to put different colors so we can see these numbers, how they come out to play. My cost to retail, only for beginning inventory, is 63.5%. So here what we are saying is that observable pattern between cost and retail, it changes year to year is what we are saying in the LIFO retail method. Here we are saying the pattern stays the same year after year. Here we are saying no, every year it's likely to change. So now for the current year, I'm going to do another calculation. So now I'm looking at only these two numbers. This is from the current year. And when I do that calculation, and this is only for the current year, okay, current year purchases only, I come up with a cost to retail ratio of 70%. So what you see over here is those numbers have changed from last year what it was and to this year. Okay, so now I need to come up with the ending inventory at retail stays the same. Okay, in all the cases, it's going to stay the same because that's what's on the floor, the ending inventory at retail. The issue now I have is my ending inventory at cost, what it would be. Now, in the previous two cases, I took the cost to retail ratio, that one number I had, 65% here, it was 68.42, multiplied it by the ending inventory at retail, and I got my answer. But now I have two ratios. So what do we do over here? Okay, so let me just do a quick thing here. No. Okay, so over here, what I'm going to do is I need to calculate, I'm going to list my layers. Okay. My layers, I'll list them. So I have $80,000 is the total inventory that I have here. Okay. How much of it is from the current year and how much of it is from the year before? 60,000 is from the previous year. That's that layer that's say from the year before, which means 20,000 is from the current year. Okay, so of this 80,000, this $80,000 number over here is broken down into 60-20. The 60 came from here. So let me put that in the green color, if I can find that color again there. Okay, the 60,000 came from here, and the 20,000 is from the second year, and that was, wait. So what was the ratio over here for 60,000? It was the 63.5%, and here it is a 70,000. I will do the calculations as an do the extensions. 60,000 times 63.5% and 20,000 times 70%, and come up with this answer of 52,100. Now that's the number that's going to be in the balance sheet, 52,100. So now the question, going back to answer the question, what would the ending inventory be using the cost to retail method, the conventional retail method, and the LIFO method? In the conventional method, it's 52,000. In the LIFO method, it's 52,100. Is the difference significant? Not really. So what should your recommendation be? Whatever is more cost effective. Remember, the accounting principle, the one that trumps all, is the benefits have to exceed the cost of doing this. So if the cost of maintaining this method is more expensive, then you can switch to this method. Otherwise, you may want to just continue with this method. The dollar amount is not significant at all. In fact, it's more significant between the conventional and the cost method rather than the conventional and the LIFO method. So once again, what we're looking at is these are estimation methods that are allowed in the retail industry. One of these methods is used very frequently. In fact, it's used by most retailers in America. So it's just a matter of which method they use. And you want to pick a method that's best for you and stick with it. Typically, it's the industry leaders that put in the time and effort to decide which method works the best, whether it's a conventional, the cost, the LIFO method. And everyone else in the industry typically just follows them for two reasons. One is because you trust that the leader has put in time and effort into selecting the best method. Therefore, why should I recreate the wheel? I'll just copy them. And the other is for comparability purposes. If I want my financial statements to be comparable to that of the others in my industry, especially my industry leader, I want to use the same accounting methods as far as possible. So this concludes the retail inventory topic. And in the LIFO, one thing that was noted in the exercise, the last sentence, there was no change in price levels. That leads me to the last video I'm going to make for this chapter, and that is when there's change in the price levels from 1 year to the next year, how we would have to adjust the estimated number that we're going to have under the retail inventory method if it's a LIFO method that we're using and there are changes in price levels. But in this exercise, there were no changes in price levels. So with that, we conclude this video.